What's up, everybody? How's it going? Welcome to another Fixated on Real Estate webinar. We're doing these every 2 weeks so that we can give you guys the most up-to-date information, get you guys some of the best investors and also industry leaders that have nothing else to do in their lives but come to our webinar. And I'm so happy once again to have Fettke with us. We also, of course, have my good friend Jay Scott, who has definitely nothing better than do but to hang out with me every other Wednesday. And then we're introducing Rick Sharga today that you guys are going to love. Definitely follow him. He's got a lot of great stuff to share, and we'll introduce these guys in a moment and tell you guys how awesome they are, like always. So today's webinar, guys, we are going to be going over mostly where are the opportunities at today, when's a good time to buy, what's happening in the real estate economy right now, and also just the economy in general, because it's changing every single day. With the new regulations and new laws and new concerns and new whatever, everything coming out. So we're going to give you guys as much of an update on that as possible from our side. And last but not least, I want to talk about also, should we be preparing for any distressed real estate? Should we be just preparing for another wave of distressed real estate that may or may not be coming because of the COVID virus and the stuff that's been going on in the economy? So I want to touch base on that. That said, let's first introduce our amazing and mostly beautiful panel, right? So first, the most beautiful, let's talk about Fettke.
Aww.
Returning guest. Second,
You
beautiful.
didn't have much competition there.
I thought for sure he was going to say one of you guys, but thank you.
No. Your husband would be mad at me otherwise. So, Fettke is co-CEO of the Real Wealth Network. She is the best-selling author of Retire Rich and with Rentals. She's an active real estate investor, licensed real estate agent, and former mortgage broker specializing in helping people build up multi-million-dollar real estate portfolios that generates passive monthly cash flow for life. With a passion for research and real estate market cycles, Fettke is a frequent guest of the CNN, CNBC, Fox, Bloomberg, NPR, CBS, MarketWatch, Wall Street Journal. She's also named among the top 100 most intriguing entrepreneurs by Goldman Sachs 2 years in a row. And I believe your guys' group, Real Wealth Network, you guys have like, what, 50,000 members in it now or something along those lines? Or
It's so crazy. Ever since this year, and especially the last 2 months, we had more new members just last month than the entire year of 2014. So it's growing really fast. It's really not what I expected.
Yeah, people want that info, and you guys give a lot of great stuff. So follow Fettke and check out her company. And also, she gives out a lot of she does a lot of broadcasts, a lot of podcasts, wealth of information. It's the Real Wealth Network. Also, we got Mr. Jay Scott, who is our returning guest panelist every single time because we love him to death, and you guys love him as well. He is CEO of 123 Flip. He's also the author of many Bigger Pockets books. He's an entrepreneur, technologist, investor, and advisor. He's host of the Bigger Pockets Business Podcast. Bigger Pockets Business Podcast. Check it out. He's done a lot of great episodes there, especially right now, very timely. There's been a lot of great podcast guests that are discussing what's going on in the business and entrepreneurial world, and that's changing dramatically every day as well. He's author of 4 Bigger Pockets books, including the book on flipping houses, the book on estimating rehab costs, the book on negotiating real estate, and recession-proof investing. He's a real estate investor that's completed over 400 deals since 2008, including flipping, buying homes, multifamily, notes, lending, all those great things. And he's extremely humble. You'll love him to death. And last but not least, our new guest, Mr. Rick Sharga, who he does not remember. But in 2016, him and I got drunk at the Omni Hotel in Scottsdale, Arizona, late one night at an IMN conference, right? It changed my life forever, but he does not remember it at all. But that's okay. He drank too much. That said, he is president and CEO at CJ Patrick Company. He's the founder of CJ Patrick Company, consulting firm that helps real estate, financial services, and technology companies develop a position of competitive advantage and use it to drive business strategy, marketing, and sales. Rick was the previous chief of marketing officer for 10X, which for those of you guys that don't know, that is auction.com. It's a real estate marketplace where he started in 2013 as the EVP of the company's auction.com business unit. Prior to that, Rick spent 8 years at Realty Track, where as SVP, he was responsible for marketing, business development, and data operations, one of the country's most frequently quoted sources on real estate, mortgage, and foreclosure trends. Rick has appeared regularly over the past 15 years on CNBC, CBS, NBC, CNN, ABC World News, Fox, Bloomberg, NPR, anything that has a camera, he is there. And he is also, I believe he told us the other day that it's a great reputation to be known as the foreclosure guy. And, you know, if I lose my house one day, I hope I'm thinking about you. So what we joked about. But that said, I'm happy to have Rick here. You guys are going to be blown away by his knowledge and his information that he's going to share today too. I'm going to start though, guys. I want to start today talking about landlords and what's going on in the rental industry right now and landlord industry, because that is probably, in my opinion, as far as real estate investors are concerned, that's been getting the most news, the most impact, the most concerns is, are tenants paying rent? What's going on with landlords today? What kind of new laws and regulations are happening? So Kathy, you help represent a lot of landlords. You guys have done a lot of deals in that department. And you also help new landlords find new properties, and also expert landlords find more properties. What have you been seeing right now? I mean, it's May, right? First time we did this webinar a couple of weeks ago was April 1st, and we're all worried if anybody's going to pay rent. Are tenants paying rent? What are you seeing out there? What are your landlords telling you? What's going on?
We were freaking out the first time you invited both Ken and I on the show. We had no idea how it was going to go. It was a really scary time. We brought all the property managers in our network together on a Zoom call like this. I think Zoom's become, the new office. And we just shared ideas together, and like, how are we going to get through this? And how do we help these tenants? It's just so important to think about them too, and not just how we're going to collect our money, but how are they going to pay their rent so they can live there? And we came up with a lot of strategies of how to help them, and how to point anyone who was challenged by losing their job, or anything that was happening, if they were sick, pointing them in the right direction to where they could get help, either get government support with the stimulus, or where to point people to new jobs, and different charitable things. So they just all kind of compiled this list of resources for tenants. They were super proactive. 2 weeks before, they were, some were actually even offering 5% discounts. Not everybody agreed with this, but some property managers were saying, look, if you pay April, May, and June upfront, we'll give you 5% discount. So just a lot of really proactive ways of understanding this was a crisis for everyone, not just for landlords. I mean, certainly for tenants too. And how can we get through this together? What has been shocking, we did not expect, is we've seen 95% collections, higher than normal, because people do not want to get kicked out of their home right now. And we have seen, actually, because we focus on the 1 to 4 units, so low density backyards and stuff, kind of more in the suburbs, you're not sharing elevators with people. We've seen more applications and stronger applications than ever that I've been in this business. So not what I expected. And then I thought, I had this idea, and then I'll stop talking, that that really would be the apartments that would get hit the hardest. But I'm just going to pull up this report, and we were wrong. Rent payment tracker for the National Multifamily Housing Council. It shows in 2019, by this time last year, they had 82% rents collected, and this year 78%. So not that bad. And then by the end of last month, so you get the full month, because a lot of people were put on payment plans, and they said, well, I'll pay a little bit now, but I lost my job, so maybe when the stimulus comes in, I could pay the rest. By the end of the month in 2019, it was 97% collections, and in 2020, 94. So when the media came out with this story, they said 30% have not paid their rents, and that was the headline news. And then when you looked into it, it's like, no, that's just not true. It was only counting 4 days of April, but they never retracted the story, and they never updated it. So anyway, I don't know. The news, just, they love to scare people. That's their job. That's how they sell ad time, to get your eyeballs. And we tend to be people who, we're like little chickens. Every time there's something scary, we're like, we gotta check it out. So that's how they know we're gonna pay attention. And anyway,
there was a headline today that drove me crazy, Kathy. It talked about late rent payments increasing by 90%. And if you read the headline quickly, it looked like 90% of people weren't paying their rent. And what it meant was, whatever the late payments were last month, if it was 3%, 4%, 90% more people. So 90% of 3% is, I think, 2.7%. So you do have to be careful what you read in the headlines. But anecdotally, everything I've heard is the same thing as what you said. Single family rental operators that I've talked to, the single housing units that are being converted to rentals, are talking about payments being as good or stronger than normal. And the other numbers, when you get them from the national associations, are kind of fuzzy. It's hard to really make out what those numbers are, because you'll have 3 reports the same day and the numbers will have a variation of 10 percentage points. And it's really hard to figure out what's really going on, but it doesn't seem as dire as a lot of the predictions were.
I want to plug this. I don't plug books, and I have nothing out of this, but what you just said, Rick, reminded me. There's a great book I'm showing you. If you guys are listening to this later, audio only, look at your speaker right now so you can see what I'm showing you. But Bad Science, it's a great book, Bad Science by Ben Goldacre. It actually talks about what Rick just said about how 90% increase or whatever, right? Well, it's taking the 2% of late payments and it's 90% of that versus 90% late. It teaches you more how to read all that bad statistics and bad science that's out there, so that you can see it with more of open eyes and more logical eyes. But it's interesting what you can do with stats and how much you can mess people up with it. But so good point on that. So, but even despite the fact that tenants are paying rent and we were all scared that they weren't, there's still people. I mean, we have friends, we had Brian Burke a couple weeks ago on, and he was just like, they still had tenants not paying rent, but it was kind of in alignment with the normal tenants that weren't paying rent. And I know Ken McElroy, I talked to him the other day, he has tenants not paying rent or they're making payment plans. So it is affecting them, but nowhere near to what we thought it could have been. But despite that, we still have all this regulation that is being pushed and all this regulation that is being put on the table to be able to be voted on. And isn't there a bill right now that California is even putting a bill out there right now that 25% rent reduction mandatory statewide or something like that?
Yeah, that's why we don't really focus on rentals in California. Rich and I just sold our last rental a month ago, and that was another interesting thing. We put our house on the market, it sold for $30,000 more. It sold immediately. I mean, so you wouldn't think that would be the case in the middle of all this, but we literally just sold it for that reason. That there's also, of course, and I don't know other states that it's happening in, but like, let's just not pay rent at all, right? Like for a year. Why should we have to pay rent? So I just decided, as I've got my news show, and I was going to do a news story on that. And I said, you know what? Rick might know this. How many renters are there in the US? It's like 47 million or something like that. It's a lot. And I'm not going to focus on the handful of people that don't want to pay their rent. I'm just not going to even give them that media attention, because most people understand you need to pay your rent. That's just how it goes. Unfortunately, in California, it's very expensive to live. That's a known thing. It's not the only place in the world to live. So if it's too expensive, you can live somewhere else. You can even live just an hour inland and it's very affordable. But people seem to, anyway, it's just where our state is headed. But I do see some awareness happening where people are realizing, that maybe that's not going to work. Other states, the states that we do invest in, they're very clear that they need to pay rent. And even if they, landlords can't evict for 3 months and that could be extended. These people in other states understand they will eventually get evicted and they will have this on their credit, and it will make it very difficult to rent next time. So it's not like they're going, yay, I'm going to take advantage of this and it's not going to affect me. They know it will. So anyway, most people do pay their rent. There's a handful in California who are fighting that, but I think there'll be enough pushback. I don't see that going through.
There's a handful everywhere that's fighting that though too. There's
yeah.
For some reason, I guess all landlords are suspected to be universally rich billionaires who own hedge funds and fly around in private jets, and that runs counter. Talking about statistics again, almost 90% of the landlords that own single-family residential rentals own fewer than 10 properties. You have similar numbers in the 1 to 4 unit marketplace. And even with some of the bigger facilities, you'd be surprised how many small businesses actually own those. So, talking about fighting back against the man, the man very often is somebody whose kid plays little league ball with yours or soccer. And you know, but I do think the reason you're seeing a lot of legislative discussion about protecting renters right now is because there's been a realization that the economic downturn we're in the middle of right now, and all those jobless numbers we're seeing, those scary, scary jobless numbers, and they are scary, are disproportionately hitting renters harder than homeowners.
Yeah.
If you look at the industries that have been hardest hit, travel, tourism, retail, restaurants, hospitality, these are all populated by workers who are typically making hourly wages at the low end of the pay scale. And if you look at home ownership rates in that cohort, they typically run at 50% or under, whereas people in white collar jobs making more than median income own homes at about an 80% clip. So the reality is that these are people who probably have no savings, who probably have credit card debt, who aren't making a lot of money to begin with. And the notion is that these are the people that are going to go sideways the fastest. And when you start seeing 33 million people filing first-time unemployment claims over a 6-week period, you know you're going to need to do something. So I think the government typically overreacts and has a tendency to create the wrong solution for the new problem. You know, forbidding evictions forever is probably a little bit of an overreaction. But because at some point nobody's going to want to own those buildings and there won't be anywhere to live. But yeah, ironically, the old Chinese curse is may you live in interesting times, and we're certainly living in them today.
Definitely. One of the, I'm sorry, didn't mean to interrupt you, Tarl.
No, go for it.
But one of the brighter pieces of economic news that we've seen in the last couple of months, and to some degree, I mean, it's a double-edged sword, but the savings rate came out last week for April, and Americans are saving at the fastest rate or the greatest rate since 1981. Which says that people are responding appropriately. Maybe they're not making a lot of money. Maybe they're making less money. Maybe they need unemployment. We don't know, but they're making a concerted effort to save, and presumably they're going to take that money, and that money, the first place they're going to spend it is the roof over their head, hopefully. So that is one nice thing that's come out of this, is that the savings rate's gone up. Now, obviously, like I said, that's a double-edged sword. Higher savings rate means people are spending less money, which leads to deflation, which leads to a slower economy. If this is a trend that continues after the lockdown ends, if people kind of come out of this with PTSD and say, I just can't spend money anymore in case this happens again, that could be bad for the economy. But short term, it is good for individuals and consumers that we're finally at a point where people are recognizing that they have to start saving again.
I think that's a great point. And I also think that it's important, like, and I just want to touch base on this, that for landlords that are out there that might be having tenants that are struggling, and to be able to pay rent, I think it's really, really important that we do work with the people that have legitimate reasons. And besides just legally, like we said, we have to on some parts right now, but also we should. And only empathetically, I say that because I grew up in a renter household that I was talking to my mom about this over the weekend. If this happened when I was like 8, 9, 10 years old, we would be one of those people that were not paying rent, right? I was on free lunch, right? My parents never had more than maybe a couple $100 in the bank ever. And they always were late on the rent anyways. I know for a fact that our family would not have been paying their rent right now because they couldn't. They would have been all deferred or lost their jobs because they're hourly workers, and the type of jobs they had, they wouldn't have had. And so, what kind of advice can we give landlords that have tenants that are reaching out to them to talk to them? And what quick advice can we give? Because there's a lot of resources out there, like you had said earlier, Kathy. But can we just touch that base and put a bow on it, and then we can move on? How can landlords help tenants right now if they are having trust?
I love that perspective, and that's amazing, Tarl. That's an amazing story. I would love to change the narrative about landlords because they're not the greedy people that a lot of people would expect. I mean, there certainly are some, but at our network, where we have over 50,000 members and growing so quickly, I can't tell you how many emails we got from our members saying, "What can we do? Hey, we don't need the rent this month. Well, whatever they need." And they really did want to take care of the tenants. And like I said, the solutions we found is, hey, payment plans, here's a list of job openings, here's the charities that could take care of you. Oh, here's the stimulus check. Here's how you can apply for that. And just really working with them. That's what worked for us.
Fair enough. Anybody else have any
You
input
know,
on that?
landlords should also be making sure they're taking advantage of whatever new government programs or whatever mortgage industry programs are available for them. So for anybody who's listening, who does own properties and maybe has a loan through Fannie Mae or Freddie Mac, they've also put in place a mortgage moratorium for investment properties. It's not quite as generous as the one for mortgage holders, but there is something for at least a 90-day deferral of payments on mortgages for landlords or investors who might otherwise be in trouble. The one area of the market I'm really concerned about, we talked about this a little bit yesterday, is Airbnb owners. If you're somebody renting out a room in your house, or if you have a property that you're using for travel related purposes, you're probably going to be able to weather the storm, hopefully. But if you're somebody who owns 10, 20 properties you're using as Airbnbs, and you've leveraged to buy those things, I'm really concerned that that's going to be one of the areas that has significant fallout in this downturn. So it's not your typical your rental property, but for that specialty category, I think they're very vulnerable right now.
Well, you brought up forbearance for a second. And so let's talk about that, because that is a question that a lot of people have right now. Like, if I take forbearance on my mortgage, how does it affect me? How many people are taking forbearance? And I think there's a misunderstanding also out there for how those forbearance programs actually work. Do they affect your credit? I've seen I know a lot of people that are in the mortgage industry that are seeing now people's credit reports show even like in deferment mortgage issue. And their banks are even telling them, don't lend on those people. Like, don't even do anything, don't touch them. Right. And that's happening on their underwriting side. But that said, I mean, I know we discussed this the other day privately, but what are you seeing on the forbearance side, Rick, and what's going on with that?
So important for anybody to know that if you don't have to take a forbearance program, you shouldn't. And that's partly because there's some hair on that thing in terms of what it's going to do for your profile. And the other is that, honestly, you want to leave the banks and the servicers available for people who really need the forbearance programs. They're getting overwhelmed. We've had just over 4 million people who have taken forbearance from the various lenders. The programs are a little ill-defined because the government decided to do the forbearance before they really thought through the structure of the program. If you're in a traditional mortgage forbearance, the way the industry has always worked, mortgage services have always worked, you defer payments for a certain number of months, and at the end of that deferment period, you're expected to make a lump sum payment for all the money that you deferred. So if you talk to a mortgage servicer, right when this program was announced, that was probably their expectation. And they've still been telling people that in some cases, that when your deferment program is over, you're going to have to make a lump sum payment. That's not the case on any government-backed loan. So if your loan is owned by Fannie Mae or Freddie Mac, if it's insured by the FHA, the VA, or USDA, they've all come out and made statements that nobody will be expected to make a lump sum payment. My technical term for a lump sum payment requirement is guaranteed foreclosure. Because these borrowers who need the deferrals are not going to have the money to make those kind of payments. And to put it in scope, about 62% of mortgages are government backed. That leaves almost 40% that are not. Those lenders are not required to do the same sort of repayment programs that the government is, but they're being strongly encouraged to do so. If 40% of the loans out there required a lump sum payment at the end of the deferral program, we would have massive foreclosures. I think the industry's smart enough not to do that, although it has been known to surprise me from time to time in the past. The deferral programs are set up to go up to, and this is not guaranteed, up to 180 days with an option for an extra 180 days at the end of that. So at most, you're looking at a year's deferral, which is intended to give people enough time to get back on their feet financially. The hope is that the deferral program goes for a lot lower period of time than that. And again, the private notes, the loans that are in mortgage-backed securities or private portfolios don't have the same requirements, probably don't have the same terms. But if you're a borrower and you're looking for one of those, remember that repayment programs are always negotiable. And the last thing a servicer wants is a lot of bad publicity about you doing something stupid and forcing somebody out of their house. So ask for a deferral program, a repayment program that lets you tack your payments on to the end of the loan, or one that lets you re-amortize the deferred payments over the balance of the life of the loan, and try and stand your ground for that. That's how the program really should work.
So all that said, when it comes to that, like, do we see anything with how is that going to affect if somebody take? Do we know? I'm not sure how this works yet. But if somebody takes forbearance and they're having it, is there going to be any kind of regulation that's going to, or are banks going to, or servicers and loan officers and everybody to look at their underwriting differently if they go later to
Of course,
refinance or buy a new house or anything?
of course, whether they say it or not, they will, is the reality. Um, the truth is that the fact is that if you're in a forbearance program, nobody will consider you for a loan modification or a refinance right now. And most of the servicing literature that I've read says that pretty straightforwardly. If you opt into a forbearance program and you were in the middle of a refinance, that's being canceled. So you're not going to be able to take advantage of the new lower interest rates. And until you're out of that forbearance program, you're not going to be considered for a home equity line, for a refi, for a second mortgage, or to bundle everything up and get a new mortgage. What will happen after that could be problematic, because if you're a lender looking at a borrower who's been in forbearance for 6 to 9 months, you're also going to be looking at job history, and you start adding up the risk factors. Here's somebody who didn't make payments for 6 to 9 months. Here's somebody who was out of work for a certain period of time. Here's somebody whose cash reserves were probably impacted. The risk profile of that borrower, even if the credit score hasn't been impacted, is going to be a lot higher than the risk profile of somebody who didn't go through all that. So it's going to be harder, whether it's something that's documented in a negative way or not. It's just the way loans are always underwritten.
Fair enough. So speaking of which, right, since we're kind of on this topic to begin with, forbearances, people missing their payments, people being forgiven their payments, renters not being able to pay rent everywhere, despite like that a lot of us are collecting rents, there's still, any kind of increase of non-payments over time, because the longer that this continues to go on, the more challenging it's going to, cause the individuals, the companies, the small businesses. Not to mention that unemployment is ridiculous right now. With that in mind, like, should we be bracing right now? This is a question for all three of you. Should we be bracing right now for in the future in 2020, 2021? There's some predictions that will we have another wave of distressed properties coming our way, and that's REO foreclosures, that sort of thing. Even in the commercial space, multifamily, single family, are we going to have more distressed properties? Is it going to be another 2008, or is it going to be similar or less than, or what? Let's start.
I bet a lot of people are hoping we're going to say, "Oh man, 2009 all over again. Go get your deals." I'll just jump in and say I don't see that happening. I know, Rick and Jay, you've got your opinions on it, but we went into this with very low inventory. Now I'm in the building industry. We syndicate, build new home subdivisions, and we did it all cash. That was one of the things we kind of knew that something might be coming, so we didn't want to take on any bank financing for construction. But a lot of builders did, and they're just out. So we already had kind of a slowdown. We already had not enough inventory, and now we have potentially less inventory, and we have more people wanting a house. There are more people wanting a space that's clean. They're working from home. They want maybe that extra office. They want their kids to be able to play outside. So there seems to be more demand, less inventory. So those of you really, really hoping for that foreclosure crisis, I don't know that it's coming, which is good for the homeowner, really. Now, will there be some? I'll leave that to you guys. Of course, there'll be some. And where do you find them? That's the big question. But it's not going to be 2009, in my opinion.
I guess I'll start with, yes, it's certainly not 2008, 9, 10, at least not in terms of the systemic foundational issues and risks that we saw in real estate, the lending market, the mortgage market, in mortgage-backed securities. We don't see any of that. I think real estate is going to be a lot more insulated this time around than it was last time. Keep in mind, pretty much every downturn, every recession is going to be driven by some confluence of factors, but typically they're different factors. And 2008 was real estate. That's not common. I mean, 2001 was the internet boom and 9/11. You go back to the late 80s, early 90s, it was the savings and loan crisis. 70s was oil. You go back to all the way to the Great Depression. We're talking tariffs and debt. And there's always a different thing that's going to drive a downturn. So I don't see the same systemic risks and issues this time around as we saw in 2008. That said, a downturn in any one sector, a downturn in the broader economy is going to affect all sectors of the economy. Maybe not equally, maybe disproportionately in certain sectors. But if we see a downturn in the economy, if we see people losing their jobs, if we see people starting to default on their debt, if we see credit tightened more, if we see illiquidity in various markets, these things are going to have a ripple effect. And it may not be an issue with real estate. It may not be an issue with lending. It may not be an issue with mortgages or whatever, but it could still very well hit the real estate industry. When people are losing their jobs, getting their wages cut, getting their hours cut, it's harder to make their mortgage payments. And when they see their unemployed and getting their hours cut and getting their wages cut, it's harder to get a loan. So these things could have a very real effect. So I don't see this being the same as 2008, 9, 10, but I won't say that if things get bad, we're not going to see a ripple into the real estate industry, and we could see a good number of distressed properties. All that said, we probably have 3 or 4 different perspectives here. We're all guessing, but that's my guess.
Totally. Thank you.
But there's some true economic indicators that are good for guessing, right? Such as you can't have 30 plus million people out of work and small businesses shut down and people not being able to make their payments and save money and not have that affect the industry. And also, Boeing saying that they might lay off 700,000 people, like all, and the airline industry might crash here soon. There's a lot of, what ifs, yes, but how could that not affect us in some way?
You probably shouldn't use the phrase crash when you're talking about airlines, just as a media note for later. Look, let's put some historical perspective to this. In a normal market, about 1% of loans are in foreclosure, about 4% of loans are delinquent, but not in foreclosure. During the foreclosure crisis back in 08, 09, 2010, we got over 4% of loans in foreclosure. So 4x what the normal range was. We had 12% of loans delinquent and not in foreclosure at the peak. So you went from a market where maybe 5% of loans are distressed to where 16, maybe 17% of loans were distressed. And that was at the time when we had more mortgages, more active mortgages than at any point in US history. Now, they weren't good mortgages, as it turned out. And a lot of the borrowers really should have been renters, as it turned out. But I agree with Jay and Kathy that fundamentally entering this downturn, we were at a very, very different place than we were in 2008. The other thing I would point out to everybody that gives me a reason to be cautiously optimistic is if you go back historically and look at prior recessions, in every recession, really except the last one, housing has helped the economy get back on its feet. So it's actually been sort of a bellwether or a bell cow that's taken the economy from a bad place to a good place. I just went through about 20 years of home sales and pricing data from First American Data Tree and found that in prior pandemics, the housing market actually outperformed the broader economy and outperformed things like the stock market. Jay mentioned 2001 being a rough year because we were getting over the dot-com bust and the terrorist attacks. And the month after the terrorist attacks, home prices went up. The month after that, home sales shot up. And we had 14 consecutive months of year over year and month over month increases in sales activity. So prior recessions, prior pandemics, the housing market has performed well. You have to parse some of the numbers that you were talking about, Tarl. 30 million people have filed for unemployment. Doesn't mean they're actually all unemployed. A lot of people believe that unemployment requirements have changed a little bit. So when you look at the jobless claims versus the jobless numbers we saw last week, they're still ugly. We still saw about 20 million people unemployed. But the light at the end of the tunnel, we hope, is that 85 to 90% of those people have filed claiming this is a temporary situation. That's not normally the case with unemployment claims. So if you went back to 2008 and you were at 2009 and 10% unemployment, to me, that was a worse figure because those jobs were gone and not coming back. And they were across the board. They were in many cases, much higher paying jobs that were eliminated. So there are ways to look at these numbers that give you a little bit of optimism. That said, oh, and one other one, we're talking about 4 million people being in forbearance. That works out to about 8% of active mortgages. If you look at that compared to the forecasts by some of the analysts who were sure the market was going to completely explode or implode, they were talking about 25% of borrowers being in forbearance. So we'd have to triple the number we currently have to get close to that worst case scenario. So again, I think there are some things that suggest, Kathy talked about demand versus supply. Demographics don't change. So the biggest age cohort we have in the country right now is 26 to 32. Average age of a first-time home buyer is 33. You know, that suggests that over the next few years, you're going to have people looking to buy a house for the first time. So I don't see demand slowing down too much from people who are going to be financially ready. And I don't see supply coming back fast enough. We were net 300 to 400,000 fewer homes than we needed over the last few years. I do think we're going to have some fallout. We entered this at almost historically low rates of foreclosures, about 0.5%. I think we could see that number triple or quadruple, which would get us back up above normal levels, but not to the levels we saw during 2008. And I do think of those properties, fewer of those will actually become bank-owned or REO properties because we have a record level of equity among homeowners. And historically, before the last foreclosure crisis, if you were a distressed homeowner, you were typically able to sell the property before the foreclosure started, often to an investor at a below market price, but a high enough price that your bank got paid off, you put some money in your pocket, got off to your next adventure, and an investor got a decently priced property. And I think that's a more likely scenario than properties going all the way through a foreclosure process and becoming bank-owned properties. One last point, and then I'll shut up. The CRE market. I'm actually more concerned about the commercial real estate market this time than I am residential, simply because there's so much activity going to prop up homeowners. Mm-hmm. I think the office market could be undergoing some fundamental foundational changes going forward because there have to be CFOs across the country right now going, why am I spending millions and millions of dollars for a big corporate office when everybody's working just as well from home? So should we be doing more telecommuting? Should we be doing more decentralization so I can have lower priced employees in lower priced markets and not have to have everybody in a big skyscraper in New York? I think the hospitality market is going to come back very slowly. I'm concerned about people that own limited service hotels. They're typically small investors. Are they going to be able to get through a cycle with 90% vacant hotels? The retail industry was already, kind of shuttering a little bit. How many of these companies that were teetering on the brink of bankruptcy are going to survive 3, 4, 5 months with no revenues? And well-known brands that are kind of circling the drain a little bit right now. So I do think we're not going to get out of this unscathed. But I don't personally buy into the notion that unless this lockdown continues forever and the economy, or we hit another really bad wave in the fall after opening the doors again, I think we have more of I call it a checkmark shaped recovery than a V. We hit bottom and we start to trickle back up in a gradual but steady pace. And maybe we're back to normal in a year or so. I'm done.
I'm gonna play a little bit of devil's advocate here, and certainly if you look at the data, that's what the data points at. But what we tend to realize or start to see during every one of these downturns is there's this law of unintended consequences, and we never there's so many things we don't know. So foreclosures are at an all-time low leading into this, but let's ask why that is. Consumer debt is at an all-time high. Refinances over the last 2 years have been at an all-time high. People are pulling equity out of their houses over the last couple of years, and they've been using it to pay their bills. Rick's shaking his head, and he probably has better data than I do, so please correct me where I'm wrong. But
Right.
with consumer debt being so high, and credit markets being so loose over the last couple of years, it doesn't surprise me that we can be in a credit bubble or a debt bubble, and yet still see foreclosure rates so low. The problem is we don't know how things domino. You imagine, let's say a hedge fund were to go under, and everybody looks around and goes, "Great, one less rich guy that we have to worry about. Good for the country." So a lot of people are going to say that, but what they don't realize is that hedge fund. Who invests in hedge funds? Your father, your grandfather's pension fund might have been invested in that hedge fund, and now there's risk to the pension fund, and the pension fund now has to diversify their risk. And how are they going to do that? They're going to move money out of equities into bonds to manage their risk. So now they're pulling money out of the stock market. Now the stock market's dropping, and now that's affecting you. So we look at a hedge fund collapsing and we think, okay, big deal. Somebody's getting hurt. I don't care. But 3 months later, now it's affecting your wallet. And so we don't always know how these things are going to cascade or domino. And in a bad case, they cascade to the point that real estate's getting hit in a market where otherwise real estate seemed pretty insulated. So I think there's just a lot of questions around what's going to happen. And certainly leading into this thing with debt high and interest rates low, and then the trillions of dollars that the Fed is spending. I mean, we're already seeing unintended consequences in the servicing industry. We've seen it in the oil industry. I mean, with crude oil at negative prices, people basically paying to get rid of oil. We just don't know what these unintended consequences are.
Anytime the government gets involved, I'm reminded of Ronald Reagan, who said the 9 scariest words in the English language are, "I'm from the government, I'm here to help." So the law of unintended consequences, I think, is something, we don't know what we don't know. So you're absolutely right there. I would probably push back on a couple things you said, because that's more fun, rather than us all agreeing about everything. One is that consumer debt was at an all-time high, but if you look at the segments of consumer debt, the fastest growing segment over the last decade has been student loans. And we're at $1.5 trillion in student loans right now. That to me is a bubble waiting to pop. We did not see a massive increase, oddly enough, in credit card debt. And the numbers have been up and down since the pandemic hit, which is a little heartening to me because it means people aren't living off their credit cards yet. But where I would push back at you a little bit in terms of, I know the consumer debt is high, probably at an all-time high, but it really hasn't been because of cash out refinances on homes. In 2008, people were tapping into equity to go buy more homes. So you had people making $40,000 a year who owned 8 properties, which turned out to be a bad idea. Until this past really 6 months, we hadn't seen much in the way of cash out refi activity. It had been mostly rate-based refinances. And I think, the consumer debt, you were talking about savings rates going up. I think that's been kind of the saving grace now. And people were it was a consumer economy, so people were spending. So the automotive debt I'm concerned about because there was a lot of subprime lending in there. The student loan debt I'm concerned about. I haven't seen the same kind of recklessness from consumers with their home equity that we saw the last time around, for whatever that's worth. And one thing that as you were talking occurred to me, because again, there are a lot of investors, big and small, who get into this marketplace. The stock market has lost 30% of its value 3 times in history, twice in the last 20 years, and most recently in March. When that happens, there's typically a flight to safety, and mostly in real estate. So I wouldn't be surprised if one of the things that maybe bails us out a little bit from the potential downturns you were talking about is if investor activity is actually heavier coming out of this pandemic than it was going into the pandemic. And people like U.S. real estate, both residential and commercial, as hedges that are a little bit less volatile than what they're getting in the stock market and some other types of bonds that are available.
Yeah, can't argue with any of that.
I am shockingly optimistic, and believe me, I haven't been, because I've been the one on stage saying, watch out, this is a bubble. We've got something coming. The fundamentals aren't there, and prices are too high and they're not affordable. So I've been really fearful, not fearful, but aware for a few years that something might be brewing. And all of a sudden, I'm extremely optimistic, and it's really weird. But I think part of it is, I think we're on the verge of a complete change, and that's exciting. We were already there. There was already lots of talk of job losses because of automation, right? Robots, and that a lot of the people who have lost their jobs, they were maybe going to be losing their jobs to automation eventually over this decade anyway. And I'm hoping that from this, what we're going to learn some really great things. And that is that there will be new jobs and maybe better jobs. And maybe they just need better training on what those jobs are. We're building subdivisions in Reno right now because there's jobs there that have never existed before because of Tesla and because of, the new, so much new technology coming along. They couldn't find anyone in the Reno market or anywhere that knew how to work on batteries, So Tesla's been investing in education in Reno to teach people new jobs, and they're good jobs, they're high paying, and they're jobs of the future. So what we've learned just now is that, guess what? My kid's at home studying, doing her exams right now. She is not out partying right now. She's right here with mama doing her college exams. And I think a lot of people are learning, well, gosh, we can do online learning. And that was something that was already on the way. It was AI was already coming, where there's already plans. If you follow Peter Diamandis and read his book Abundance, so that you just feel better during these times, and he has a new book out, a very, very positive thinker on where our world is headed, and it's better than we think. And if we can collectively think that way, I think we can create a better world instead of really predicting Armageddon. That's not a collective positive thought. So if we can really look at, wow, if not everyone has to pay for college, not everyone has $100,000, they can't take out that loan. What if they can learn online? And many colleges have suddenly figured it out. Chris has been saying, Mom, they just couldn't figure out this online thing. She took the wrong test today because they screwed it up. Just take it again because it's the wrong test. Anyway, they're figuring it out, just like we're figuring out how to do business online. I mean, Real Wealth we've been remote for 5 years and we love it. We were more productive. So I want to see the positive coming, the good things coming, and focus on that. I also agree with you, Rick, that the banks learned that putting a whole bunch of properties on the market in foreclosure was not necessarily good for the market or for their assets. So they stopped and they started doing more loan workouts and just having people stay in their home. And they even got in the rental business. They even got in the fix up business. They started fixing up homes and selling them for a higher value because they didn't like the discounts of the assets that they were holding. So I don't think they're in a big hurry to go through that again. They learned. And also we have a country that, we've been on a fiat system where money has just been created out of thin air. We're seeing that doesn't really work. But what comes with that is money comes out of thin air. It also disappears and goes to where it came from. So many of these people that have massive credit card debt, they're going to file bankruptcy. They're going to walk away from that debt and they're going to be debt free. That also means now they're not burdened with the debt, but they also will have to rent for the next 10 years potentially. So there's positives and negatives. And then finally, one last thought, and this is really out there, but I'm just going to share it, that there's been some changes to the Fed, and it could be incredible. It could be the change of everything, but I'm just going to give my prediction that we have now brought the Fed into the Treasury and kind of taken control of it. And in so doing, I mean, up until now, the Federal Reserve is really the banking system, a handful of powerful bankers, and they've been kind of calling the shots and making money out of thin air and charging the US government to borrow it with interest. Well, now we're talking about negative interest rates, and everybody's been like, that's crazy. Well, what that means is now everything's reversing, and potentially the Fed is going to have to pay to lend to us. So everything is changing. Everything is reversing. I personally think there's a lot to look forward to. And I also know we have a president, love him or hate him. I'm from California. So listen, most people here hate him, but he is going to do everything it takes to bring this economy back. And there's a lot of people who still, they're not Trump fans, but they're saying, you know what, I don't want to be in California and be shut down for another 3 months when we're kind of finding out that maybe it's just 99% of the population that's affected. I mean, 1% or so that's affected by this, and the 99% of us aren't. So there's more and more data coming out. And I just think, even if this is a horrible virus, and it is for sure for a certain segment of the population, we have the greatest minds in the world coming together on Zoom like we are, figuring it out. We're fighting a common enemy together with the best technology and the greatest minds ever in the history of the US. So there's my rant. There you have it.
We all get one. So what we're going to do right now, and I want to summarize this on a few points, and then we're going to start getting into your guys' specific real estate questions, specifically, and how we can help you on that, and then on those points, and give you guys some feedback on that part. There's been some comments, some chats, and I just want to hit on this. The reason why this particular webinar, and these webinars typically are more on a global economic level and a U.S. economic level, and not so much specifically on like, hey, I have a single family house in bum blank Egypt, and I need help on should I get a roof or a kitchen. Like that's not what this is about, right? All of these economic factors tie into real estate. The reason why we are focused on these economic factors and economic indicators and challenges that are going on in the U.S. is because as investors, those things affect what we invest in, right? What's going on with people's rent payments, mortgage forbearances, defaults, all those things affect all of us, whether you like it or not. It's not a simple fix and flip situation where you buy a house at a discount, put it on the market because you fix it up and you're good to go. Long term, that's not how real estate works. So real estate's affected by a lot of other factors. That's why we like talking about this stuff. So that said too, I've also learned doing these and watching people talk and listening to people talk is that you have the eternal optimist and the eternal pessimist, and you're going to be right whichever one you are, right? Because you're going to be looking for those situations. You're going to look for the data that you want to see. You're going to be hopeful that it's going to crash because you want it to all burn, because you want to buy everything and have blood on the streets and all that kind of stuff. Or you're going to be optimistic that it's going to be fantastic and it's going to be all happy. But you might be optimistic because it crashed because you're going to make a lot of money on it. Or you might be the other way. Like whatever you believe right now, you're going to find that information. And I've seen that throughout history of my life in any facet. So that said, we all are economically guessing based off of good indicators, and we're all hopeful one way or another. What I would say is that if you're watching this right now, what can you learn? What can you take from these feedback to be able to use for your own personal life, your own business, to be able to potentially prepare for whatever it might be that might help you elevate your guys' family's financial future, your personal financial future, be able to survive and thrive what's coming in the future. Whether it stays the same or whether or not it crashes, it shouldn't matter as long as you're prepared for whatever is going to happen. You can take advantage of it because that's where the opportunities come from. That said, I'm going to share my screen because we're going to take a quick break, and I'm going to show you guys a couple of things that we got coming up as a conference. Once we do this every 2 weeks. The next one that we're doing right now is 2 weeks from today, and that is we're going to have Ken McElroy back on the show. So you make sure you guys check that out. You guys can go to fixatedonrealestate.com. Watch all the past webinars. We record everything from our live events that we do as well, even though we're not doing live events right now. It's all there for free. You guys can watch that anytime, fixatedonrealestate.com, and also future webinars. That said, too, we also have the Pacific Northwest Big Badass Real Estate Wealth Expo. We host it every year. This is the 4th year that we're doing it, 2020 in Seattle, Washington. Yes, there is a pandemic. Yes, there might be issues with us hosting it, but that's okay because it's a hybrid event because we're offering a virtual component to it as well. It is August 6th through the 8th, 2020. Last year, we had over 49 presentations, panelists, speakers, all that great stuff. We had 71 vendors. It's at the Hyatt Regency, downtown Seattle. Go to pnwrealestateexpo.com. It gives you the options to be able to choose it that you want to be able to view it live in person and show up to all the networking, the dinners, the parties, the speakers, networking like crazy. Learn as much as you can from that, or attend virtually only and avoid the crowds and stay at home and watch it from anywhere in the world and participate in the networking through our apps and things that we have as well. Right now, tickets are on sale. We have $349 for the in-person ticket, and we have $149 for the virtual only. Both receive all recordings, and you can participate in all sessions and network with all exhibitors, presenters, so forth, whether you go virtual or in person. From my experience and everybody else that's on this panel, in person is always better. But if we can't host it actually live, which we believe we're going to be able to in Seattle, August 6th through the 8th, it'll be 100% virtual. Either way, if you buy your in-person ticket and we end up switching to all virtual, you'll get refunded the difference, and it'll all work out. So that said, you can buy tickets today. Last but not least, we also help sponsor Exact Skip. So if you guys are looking for off-market deals or people that might be potentially being able to sell their houses and you need to find out who they are, exactskip.com is a company that we help support as much as possible for real estate investors and supporters to help find those homeowners that you can't get in touch with because you want to be able to buy their house or their property. So check out exactskip.com as well. All right, enough about that. Let's move on with what's going on with not so much like global economy. We're done with that, right? Unless it affects what we're about to talk about, right? Let's talk about opportunities. Let's talk about where real estate is today. When should we be buying? Should we be buying right now? Should we be waiting? Should we not? So let's start with that. Let's say, should we buy real estate now? And this is kind of a loaded question because there's lots of different forms of real estate. But if you're investing right now, I'm investing right now, right? What should I be doing? Should I buy or should I wait? Jay, what do you think?
I have the unpopular answer. So I will rarely tell people it's a bad time to buy real estate. And I'm not saying it's a bad time to buy real estate. It's a risky time for those who are not overly experienced to be buying real estate right now. And when I say right now, I'm not talking about 2020, the next 3 years. I'm talking about today. I'm talking about probably tomorrow. Maybe next week, things are going to open up and it won't be a risky time. My biggest concern right now is that we don't know the true number of buyers out there. We don't know the true number of sellers out there. We have a very inefficient real estate. Most real estate markets right now are inefficient. And in an inefficient market, when you don't have the full number of buyers and sellers, you don't know what true values are. And it's possible in 3 weeks, things are going to open up and prices are going to drop. It's possible in 2 months, things are going to open up, prices are going to go up. It's possible that in 6 months, things are going to open up and prices are going to stay the same. The problem is right now, the markets are inefficient. And once they become efficient again and people are listing houses, everybody that wants to list a house is listing, everybody that wants to buy a house is buying. At that point, we're going to see something in the market. Up, down, stay the same, we don't know. But at that point, that'll give us some confidence in values. Right now, I don't have a tremendous amount of confidence in values. If you're an expert investor, if you know how to mitigate your risk, if you know how to kind of assess your downside and underwrite to the worst case scenario, and your numbers still work out, absolutely go out and it's always a good time to do a buy and hold if it's cash flowing. If you want to risk doing a flip and you can assess your worst case numbers, go out and do a flip. But if you're not confident in your ability to do whatever right now, I'd say sit back, spend some time watching these webinars, spend some time on Bigger Pockets, go read some books, put together a business plan, start to learn, start to get prepared. And then when things start to open up and we see more efficient real estate markets, whether that's 2 weeks from now, 2 months from now, or 2 years from now, hopefully it's 2 weeks, then it'll be a much better time to go out and actually start doing deals. Just my opinion.
Fair enough. Rick, what do you think?
I think I have to take myself off mute first. I really hesitate to give anybody timing advice. I think I can give you a couple perspectives. One is, I think affordability numbers are misleading. I've been following some work from Mark Fleming, who's a chief economist at First American. He does what he calls a real price index. And if you look at property prices over the last 20 years, and take a look at affordability levels. If you just look at nominal house prices, of course, they kept going up. In some markets, you get sticker shock. But if you factor in interest rates and you factor in wage growth in the same period of time, you find that people actually have more home buying power today than they had even before the boom and bust cycle last time. And in 2006, interest rates were 6.5%. You drop an interest rate by 3% on a mortgage, it makes a huge, huge difference in affordability. So I think affordability issues might be a little bit overrated. I do think if you're an investor, there will be some distressed inventory hitting the market, which to me poses an opportunity for fix and flip investing. Probably in some markets that you've been out of for a while because property values have gotten too high to make that kind of return. I also think that there are a number of people who might have been ready to buy a property who are going to have to rethink that because they've been out of work during this pandemic, and will become renters for a time rather than home buyers. So I think there's going to be some opportunities to buy rental properties as well. But in terms of market timing, the question is really how long does this pandemic shutdown stay in place? How many businesses survive the shutdown because of how long it was? And therefore, how many jobs are left over at the end of that cycle? Because the one thing I've learned is almost absolutely true from an historical standpoint is jobs equals home ownership, or jobs equals home sales. And if we continue to bleed off jobs beyond what, the end of this pandemic, it does pose some challenges from a buying perspective. But as the president, who we've mentioned a few times today, was fond of saying back when he was just a real estate investor, savvy real estate investors can figure out how to make money in market downturns and market upturns. Absolutely. So it's not a question of whether to buy, it just might be your buying strategy and what you do with the properties that you're purchasing.
I agree with that. I mean, I'm already seeing in our market here, I'm starting to see lease options show back up a lot, right, than they used to. And, over a year ago when we put stuff on our rental market here, nobody was really doing it. I mean, you'd barely see them. And we just put a couple properties on the market for rent because we have a bunch of BRRRRs, buy, rehab, rent, refinance, repeat stuff going on right now for our portfolio that we're finishing up. And when we're pulling all these comps for our rentals, we're seeing a bunch of lease options. We're like, all right, we haven't seen those in a little while. And so, yeah, I see those come back when markets start changing and turning and so forth as well. So it is your investment strategy that could be a huge factor. Hey, Kathy, what are your thoughts?
Just, I'm sorry, but one more point on prices, since you guys have mentioned this, and I saw a couple questions on it. Supply and demand drives prices. I don't expect to see a glut of properties on the market anytime soon. I'm not as young as the rest of you guys. I'm not sure I'll see it in my lifetime. And a glut of properties is what would drive property values down. In the markets we've seen reopen, and North Carolina is a good example of this, we've seen a huge return to market of buyers and almost no increase in inventory. So until we see a bunch of inventory hitting the market, or until Kathy starts building properties, at a crazy rate across the country, I think supply levels being down are going to keep prices from cratering, at least for the foreseeable future. Sorry, now I'll let you get to Kathy.
That makes total sense. I mean, like the psychology of what's going on right now too, we could only assume this, but like if you potentially lost your job or you're fearful of losing your job, is right now the time you should be upgrading your house, right? Or is right now the time that you should leave your house, especially maybe you're already in a forbearance, like should you be selling it? You probably can't sell your house, but it's all these, there's truth to that. Maybe that just makes people want to stay put more because of fear of the unknown too. So, which also then helps supply, which reduces supply, which then raises pricing. So that's a good thing. Kathy?
I think you kind of said it earlier. I don't think you should invest, or maybe Jay said it, you shouldn't invest until you understand investing, so if you're new to investing, spend this time really learning and being on webinars like this. And when you decide which asset class you really like, and when we say real estate, that is just so broad. It's like saying the weather, in America is 60 degrees or whatever. It's just different everywhere. So you have to pick the asset class that you like. Look into single family homes, look into multifamily, look into flipping, wholesaling. And when you find that thing that just resonates with you, that's like, wow, people just seem to know which one they want to do. And then dive in and read 3 books on the topic thoroughly. Jay's got a bunch of them. And then, listen to 3 podcasts all the way through on that topic and learn it so well so that you won't even have to ask yourself if now's the time to buy. You'll know. And that's the difference. So one of the things we do is follow the demographics. And we know that there's been more than, 23 million people since the last recession, but we haven't had the new construction to go with it. And we've also been following the demographics where a very large group of people are moving to where it's affordable because of so many reasons that we mentioned today. So looking for affordable markets or affordable properties within your market. And we're seeing a lot of move into the Southeast Southeast. Now, it turns out the Southeast tends to be the parts of the country where they're opening up the economy. So we'll be kind of watching closely to how that goes. But just again, there's real estate. There's just no such thing as real estate. There's just a whole bunch of markets, a whole lot of asset classes. Pick one and really focus on that and learn it. And you'll know when it's time.
Yeah. And Rick said something earlier that was really important, and it's that not every asset class is performing equally at this point.
Yeah.
If you're in the commercial market, you're going to be looking at much different risk profiles and opportunities than if you're in the single family market, than if you're in the multifamily market, than if you're a lender. And just to underscore what Rick was saying about office space and commercial, I had a couple friends last night who work at Twitter who told me that as of yesterday, the CEO said nobody ever has to come back into the office again, ever.
Wow.
People can work from home permanently as of yesterday at Twitter. And if a company
Wow.
like that is going to make that pronouncement, how many other companies are going to follow suit?
Wow.
And how many other companies are going to realize that, wow, this is an opportunity for us to really get more cost efficient on our real estate and our office space. And it's a lot cheaper to just set up a Zoom or other teleconferencing software or technology and save on office space. And so there's going to be a glut of commercial office space. And so that industry is going to likely perform much differently than a lot of other asset classes in real estate.
Sounds like there's a lot of conversion going on from commercial to residential soon, right? Yep. So, but who knows? If you guys listened to last 2 weeks ago's webinar with AJ Osborne and Brandon Turner and Jay Scott and I, AJ spoke a lot about commercial real estate and how that's affecting his portfolio because he invests solely in commercial real estate. So if you guys want to listen more and go down that path, check out the last webinar we did with AJ, Brandon, and Jay and I. And you'll learn a lot on that, especially with those opportunities that might be coming up there. AJ specifically invests in that field, and he believes that he's going to increase his portfolio by at least 50% over the next 2 years, just in that market segment because of what's been going on in commercial. Not because he thought that it's going to like drop and be destroyed and be gone. He just feels that there's going to be a lot more opportunities to be able to buy. And because there's going to be more landlords selling, more people not being able to uphold uphold the financials of it or the stress of running it, and he'll be able to come in and start buying them up. So that said, on that part, what do you guys think that, and I like asking this question, what do you guys suggest that investors not be doing right now? Like, what shouldn't we do?
Don't curl up on a ball and cry yourself to sleep. No, I know a lot of people that are wasting time right now that are kind of, it's the number of people that tell me like the number of TV shows they're watching and the other random stuff they're doing. I know a lot of us are busy. We have kids, and I know anybody with kids is busy. But I would say this is an opportunity for a lot of us. And again, I'm not downplaying those that are working 2 jobs still and those that have kids. But for a lot of us, we have some time now that we haven't had in recent history. Don't waste that time. Don't be one of those people that looks back in 5 years and says, wow, I had 3 months where I was collecting unemployment and I sat on the TV. It sat in front of the TV as a vacation instead of working on a business plan, instead of working on raising money, instead of working on reading books and going and watching these webinars and Kathy's podcast and reading everything Rick's ever written. I mean, there's some brilliant people out there that we can learn from, and now's the time to do that. Don't waste this time.
I would agree with that, and enjoy this has been a time to slow down and reset in many, many ways. And I think people are reevaluating what's important, myself included. I mean, you guys know I've been in a different city every single day because I've seen you in those cities, and we've been traveling a lot. And let me tell you, Tarl, I'm going to be in Seattle. I really hope so. But this has been an amazing time to be home. And then my kid came home from college. Who knew? And we've just been really reprioritizing what matters. So that's probably the place to start, is what are you doing it for? Because what I've seen so often is that in myself included, to get on this more cycle of, it becomes a pattern. And if we lose sight of why we're doing it and what really matters, that you can get lost in that. So be sure you really know, this is what I want. This is my goal. And when I get there, I don't have to keep pushing maybe. So that would be a good place to start, is just really get clear on what's most important to you.
I would, boy, both of you just gave great life advice. So I'm not going to try and, not going to try and add much to that. But, you know, from crisis often comes opportunity. And I guess my two pieces of advice are: don't assume that everything will be the same after the crisis as it was before the crisis. So what you used to be doing may not be appropriate anymore in the new world. And the flip side of that is, ask yourself what's different and what's going to be needed to meet those different needs as we come out. If I had unlimited capital, I would be looking at senior living right now really, really closely, because what we have found is that in a pandemic, a nursing home is a really bad place to be. And so, you know, what are the opportunities that you might not have thought about prior to this that would make a lot more sense to think about because of how the world has changed? And make no mistake, the world has changed.
And if you want a good location for senior living, there are probably a lot of hotels out there that are going to be selling pretty cheap.
Wow. Yeah.
Well, and malls. I mean, my running joke, being you know, one of the token boomers on the panel today, is that when my generation was growing up, our parents used to say to us, you know, why don't you just live at the mall, because you spend all your time there anyway. And now maybe we're going to be able to, because we're converting those suburban malls into multi-use facilities that sometimes include housing. So yeah, I mean, think out, you know, the cliche, think outside the box. But again, ask yourself what's changed, ask yourself what's needed because of what's changed, and then ask yourself if there's something you can do to optimize your returns based on those two questions.
Love it.
So I'm going to add in there on the single family side. So I had a question for you guys, for myself personally, but also I want to add on, there's a question here that these days are you buying flips? This comes from Jesse. These days, are you guys buying flips, assuming that the market will drop a certain percentage? For example, assuming a worst case scenario of 15% drop in ARV after repair value, and building that into your purchase price. I'm going to take that really quick. So I do a lot of flips, right? We've done a lot of them, like hundreds and hundreds and hundreds. And right now during the pandemic, we did buy property, but we haven't really dramatically changed our buying criteria. We've just been a little bit more like, do we have to, right, buy it? And it's good to be in a place where you don't have to buy real. Actually, nobody has to buy real estate. I just want to throw that out there, unless maybe you run a huge fund that you're required to because you got like obligations and stuff like that. But outside of that, you don't have to buy anything. So for us, yeah, we bought a couple flips and stuff right now, and but these are properties that we probably would have bought, but they are way better than than, like, how do I say it? Like, they're really good flips, right? So despite what's going on in the market could take a 10, 15, 20% dive and we wouldn't lose money, right? So it doesn't mean that we're going to make a ton of money on them, but if at all, but we wouldn't lose money, right? And that's kind of how I look at stuff, is how do I mitigate risk? So my goal is like, not how do I make a ton of money on this property, is how do I not lose any money on this property? That's kind of like how my head goes, especially with what's happening right now. So I'm like, okay, do I keep moving forward? Yes, I buy this house. It's great. We bought a house in Lacey, Washington just the other week. It's a 26% cash on cash return, right? As a fix and flip, that's going to cost me less than 15 grand in rehab. Why wouldn't I buy that right now? Especially then, since I think that the market's going to go up here soon because of the lack of supply and everything in those areas. So of course I'm going to buy it, right? Even if the market drops 20%, I don't lose any money, right? So I would just be more conservative on that, not have to buy anything, right? And just, you know, like Jay said earlier, is that if you're new to investing, then maybe, you know, be very cautious, right? Because you don't have multiple exit strategies, that kind of stuff as well. So I don't know if you guys want to add to that quickly, but
just to add real quickly to that, I'm a big fan of history is the best predictor of the future. Know what your market did in 2008. We're hopefully, and I don't expect that we're going to get anywhere near what happened in 2008, but I think 2008 was a good worst case scenario for us to use as a historic benchmark. And in some areas, 2008 was pretty disastrous. In some areas, 2008 wasn't that bad. Whatever happened in 2008, again, assuming the demographics and the population and employment stuff in your area hasn't changed much. 2008 is probably a worst case scenario. So if I'm going to do a flip in Maryland, in a county that I do a lot of flips, I know that in 2008, the market dropped about 12%. So as long as I'm doing a typical flip where I have at least 15% margins in that place, as long as we don't see anything worse than 2008, I'm not going to lose money. But now I live like near the beach in Florida, where back in 2008, we saw 35% drops in prices here. If I'm going to do a flip here, I'm not going to go after a flip that's generating 15% margins because I have a much higher risk profile. I'm going to want to see 20 or 25% margins on the flips I'm doing here to insulate myself from that kind of worst case scenario. So look at what happened in your market or whatever markets that you're investing in back in 2008 and kind of say to yourself, here's the worst case scenario. Am I underwriting this deal to that worst case scenario? And am I willing to absorb whatever risk that gives me?
Love it. I'm going to add one last piece and then we're going to move on to the next question, but, and then we'll start wrapping up. I believe, like, I've been a very, very conservative investor the last couple of years, mostly out of laziness, right? And because I just haven't wanted to like do a lot of work because we've done a ton of deals in the past. What I've learned from being more conservative is that I haven't lost any money on any deals in the last couple of years, right? So, but I've also lost out an opportunity on making more money on other deals. And so is that the worst thing in the world? No, right? It's not. So I'd rather not lose what I built up. And right now you can be very aggressive if you want right now, just like you could have been aggressive before the pandemic. So it's up to you guys where you're at. Speak to what kind of like house money can you play with? That's kind of like the idea, maybe as an idea. Like if you've ever gone to a casino, once you make a little bit of money and everything, then you put away your principal and then you invest with the casino's money, right? Maybe there's a strategy there for what you can do in real estate right now. I don't know. That's up to you. The risk is yours. So that's it. I have a question specifically on my portfolio, and maybe you guys can help me out with this. And I'm sure other people have thought about this that has rentals, right? I have a bunch of rentals, right? A bunch of single family. I don't have any multifamily. I have like a couple duplexes and triplexes, but that's about it. And a whole bunch of single family. So should I sell any of my portfolio right now? And should I actually should I get more liquid? Should I keep my money in my real estate? And that's pretty much what I'm looking at here is like, should I be getting liquid or should I keep my real estate?
I
Sell
mean,
anything that you don't want to be holding for 5 or 10 years.
I would say, we're seeing a flood of money stimulus being created, and generally speaking, in the past, that lifted asset values up. That's why generally they do it. And so when we came out of the last recession, because so much QE, so much money flooded into the market, and we saw that affect real estate and stocks. Now, if we were to look at history, that could be the same again, that when money becomes plentiful, the cash part of it, then could that mean that the hard asset is more valuable because more money's chasing it? So I would say a little bit of everything. I mean, some people are buying gold, a little bit of gold, having some cash ready, and then also putting, money in real estate, because let's just say the currency completely collapsed. I mean, I'm just going like if things just went to hell, and the currency collapsed, well, you'd have something valuable in real estate. So I'm hoping that doesn't happen, but there's always,
as long as we
anything's
still have
possible.
Private property rights, like as soon as we still have private property rights by then too. So yeah, there's some weird laws that they're being projected out there, which I don't want to go down that rabbit hole right now about some of the representatives that are trying to push a bill to say that we need to give equity to our tenants. And even at one point,
what?
I shall post it later. But there's that same bill is saying that if a landlord violates it 3 times, the U.S. government can seize their property from them and take it from them. There's some crazy shit out there, right? Anyways, that's point. Rick, do I liquidate? Do I keep my real estate? Like, what do I do?
I tell people that if I knew the answers to these, I wouldn't be doing Zoom webinars. I would be in my private island somewhere in the Caribbean.
That's true.
But here's what I guess the question back to you, and you all know this from working with investors and doing training for investors. You have to ask yourself what your end game is, what your objective is. And part of that process is asking yourself the question, if I liquidate these assets, what am I going to do with the capital that I get back? And is there a better option for you today? Are you going to use it to go buy and get better properties? Are you going to put it in a bank account where you're going to make 0.5% interest? Are you going to put it in the stock market, betting on a rebound there? So my question for you is, the answer to your question is, what is your long-term objective and what's the right strategy to help you get there. And again, if you're going to liquidate these assets, what do you do with the capital that you get back that's going to get you closer to that long-term objective?
Great advice.
And from an IRR perspective, keep in mind that it's very costly to buy and sell property. So yeah.
Internal rate of return for those of you guys listening.
Yeah. And when you just go back to fundamentals, I mean, forget that we had 10 years of an up run. I mean, it was a unique time in history. I wish I knew what had been coming, and I bought everything in 2009, but that was a unique time. But if you really just go back to the basic fundamentals of real estate, where you're borrowing money to buy an asset, sometimes, you know, if you buy your first house and you put 3% down, you're borrowing 97%. And yet it's your asset, and you get all the tax write-offs and you get all the cash flow. And then if you rent out the asset that you borrowed money on, you get someone else to pay that debt off for you, such that in 30 years, you own it free and clear. There's a very good chance it's going to have gone up in value over 30 years. So just from, and you know, maybe not everyone wants to wait 30 years. You can accelerate the payoff by paying, you know, making that extra payment a year or whatever. I mean, there's ways to accelerate it so you don't have to wait 30 years. But if you just really focus on fundamentals and forget everything else, it kind of makes a lot of sense. And then add the tax benefits on top.
And one other thing, I'm not a huge fan of lots of debt, but what performs better in an inflationary environment than debt? Nothing. So pay off your debt with cheaper dollars.
I guess that makes sense. All right. So I'm going to sell everything tomorrow. Got it. So the for
leverage everything tomorrow. Refinance.
Oh, leverage. Yeah. I got to do that. We can go down another whole presentation on what's going on with cash out refis right now. So, but for time's sake, because those are getting more challenging out there in the industry. For time's sake, though, we're gonna have to wrap up. So that said, Kathy, how can people get a hold of you?
realwealth.com is our website, and we got lots of it's free to join, and lots of data and information. Not Rick's data. Rick, I'd like some of your data on there, by the way. But lots of information on different markets and why we like them, and ways to start. So realwealth.com.
And Rick Sharga.
Yeah, look, I'm pretty easy to find on LinkedIn and Twitter. You can certainly visit my company website if you like, cjpatrick.com. But you know, reach out and follow me on Twitter. Connect with me on LinkedIn. Tell me you're one of Tarl's friends, and I'll make sure to sign you up. And if you're interested in this kind of real estate discussion, I am posting pretty much constantly. So, you know, happy to make new friends in social media.
Perfect. And Mr. J. Scott.
Best place to connect with me is right here on this webinar again in 2 weeks. I
Yeah.
like that, shaming you into bringing me back. I am, let's see, jscott.com, jscottinvestor on Facebook. Check out my wife and my podcast, the Bigger Pockets Business Podcast. Real estate is a business. So whether you run a business outside of real estate or you're just a real estate investor, you will learn a lot. So check out the podcast, and always feel free to email me, the letter J at jscott.com.
Love it. Kathy, Rick, Jay, I really appreciate you guys being on this. For those of you guys that make sure you guys, if those of you guys are still on this right now or watching it as the replay, reach out to these guys, join their networks, follow them as much as possible. You'll learn a lot. Make sure you guys still follow Bigger Pockets, right? Bigger Pockets. We do a lot of videos on that too. We'll do another one next week with them. And of course, you can follow me at Tarl Yarber on Instagram. And we will be posting this webinar later on our YouTube channel, and also emailing it out to you guys for the recordings, so you guys can have that. Check out pnwrealestateexpo.com so you can meet us all in person, as long as we're allowed to, which we should. And if not, you'll see us virtually there as well, or both, right? Who knows? So see you guys in 2 weeks. We're going to have Ken McElroy back, and Jay Scott, of course, and one mystery person. That seat is to be filled. And we will continue this going forward into the indefinite future. Thanks, guys. Love you all.
Thank you. Bye.
Bye.